Hello students, today we're going to be continuing our review for your semester exam, and we're going to start off with classifying some expenses. And for number 1 through 7, we have to decide, are these examples of fixed expenses, are they variable expenses, or are they irregular or periodic? We call fixed expenses stay the same amount for each month. These are monthly expenses that stay the same each month. Variable expenses change amounts each month. So again, these are monthly expenses. They occur each month, but they change in payment each month. And irregular or periodic, they don't occur monthly. These may occur every couple months, once or twice a year. So let's go through our 7 examples and classify. Number 1, paying each month for a Netflix subscription. Well, Netflix subscriptions, you pay a fixed amount each month, $13.99 for your package, $19.99 for the package. So that's an example of a fixed expense. Clothing is something that most people don't purchase every month. This occurs maybe for back to school, maybe for a special occasion. So I'm going to put clothing in the irregular or periodic category. Rent or mortgage, that's another example of a fixed expense. It stays the same month to month to month. Your internet bill, well, if you're on a payment plan, like you're paying, let's say, $79.99 every single month, then that's an example of a fixed expense. Although there are plans that you pay for the amount of usage that you take on, most internet bills are fixed expenses. Just like college loan payments. As soon as you graduate college, they kick in for 10 years. Those are fixed payments. Your phone bill, again, another example of a fixed expense. But irregular or periodic would be an example of Halloween decorations. Anytime you have a yearly celebration, that type of thing, that would be considered irregular or periodic. Now again, could a phone bill be variable? Could you pay based on the amount of minutes that you use? Yes. And you'll be told on your semester exam whether it's the same amount every month or whether it changes. But I just wanted to go over the different types of expenses. Here are some definitions for you. Something owed to another, an obligation to pay. Those are known as debts. A spending plan for managing money during a given time period. That's known as a budget. A budget is your spending plan. Usually you set up monthly budgets. Money earned through employment or investments. Those are known as income. Purchasing groceries. This is an example of a variable expense because grocery amounts change from month to month to month, but that's not one of the answer choices. Well, that's going to be one of those needs. You have to eat, so therefore that's known as a variable expense. None of the others match for that particular answer. And finally, this last one is absolutely true. The goal of a budget is to be able to save money and enjoy life. So that's true. Now we have some definitions that we talked about in the budgeting section of our course. Well, a budget is the spending plan for managing money. So that's going to be known as a budget. Something owed to another, an obligation to pay. Those are your debts. Amount of money spent to buy goods or services. We just talked about fixed, variable, and irregular or periodic expenses. Well, that's just the definition of expenses. Money spent to buy goods or services. And we just talked about the fact that where the amount you pay each time is the same. Fixed expenses. Budgets need to be flexible. They need to be able to be modified or adapted. Money earned through employment and investments is your income. The process of using a financial plan to control your money, that's money management. Like you're taking financial literacy, but you're really learning the art or the skill of money management. The act of spending more money than you actually have, that's called overdrafting. That's an example of negative cash flow, when you spend more than you make. When you earn more than you spend, that'd be an example of a positive cash flow. There you go. Costs that do not occur on a monthly basis. Those are irregular or periodic expenses. Costs which change in amount each time they're paid. Variable expenses. Ranking needs and wants in order of importance. Very, very important. When you set up your budget, you have to prioritize. You rank what you need and want in order. Your income after taxes is known as your net income. Your income before taxes are taken out, before taxes, that's known as your gross income. You should always have an emergency fund, money dedicated to covering unexpected expenses. The key for budgeting is you want to try to have the self-control to postpone satisfaction. That's delayed gratification. Because what happens is it's always easy to give in to that immediate sense of reward, the instant gratification. Unplanned, spontaneous purchases, sometimes triggered by emotions, that's known as impulse buying. And then spending money on non-necessities or wants, that's called discretionary income, discretionary spending. So those were some of the terms that we discussed in our budget section. Now these last 2 pages deal with the vocabulary that come from our insurance unit. And the largest amount of money you need to pay for a medical expense or service during a year, that's known as your out-of-pocket maximum. If you, God forbid, reach your out-of-pocket maximum, then the insurance would cover the rest of the bills. But a lot of times, your out-of-pocket maximum is a pretty high amount. The amount of money you pay each month to be covered by your health plan, that's known as your monthly premium. Your premium is the amount of money that you have to pay each month for your insurance benefit. The amount of money you have to pay before your health benefits kick in is known as your deductible. So let's say you have a $500 medical bill, but you have a $100 deductible. You have to first pay $100, and then your insurance plan and you will work out a payment for the remaining $400. So that's going to be your deductible, the amount of money you have to pay before your health benefits kick in. What happens is the percentage of your medical bill that you have to pay is known as your coinsurance. So in this previous example, if you have a $100 deductible on a $500 medical bill, you have to pay the $100 first, and then your coinsurance is the percentage that you have to pay once you met your deductible. So let's say your coinsurance is, let's go 25%. That means, okay, you paid your $100 from your $500 bill, so you cut it down to $400, and then you're responsible for 25% of the rest, which means you're going to be paying an additional $100, and then the insurance company will pay the $300 to make up the $400 bill that you owe. And then finally, the fixed amount that you have to pay each time you get a medical service, that's known as your copay. So let's say you go to the doctor and you have to see the doctor. Well, your copay could be $50 each visit. Here are the insurance vocabulary that we talked about for healthcare. Like I said before, the premium is the amount of money you have to pay each month. The deductible, the amount you have to pay before your plan kicks in. Out-of-pocket maximum. After you hit this amount, with your deductions, your deductibles, your co-payments, your co-insurance, then everything else would be covered 100%. Preventative care helps detect or prevent serious diseases and medical problems before they become major. And what happens is a lot of times insurance companies will pay for preventative care to make sure, hopefully, that you don't get really sick, because if you get really sick, then that's when the medical bills start to really pile up. So your preventative care, a lot of times, is covered by your insurance company. Again, here's our copay, the fixed dollar amount that you pay at the time of getting care. The coinsurance is the amount you pay, calculated as a percent, after you hit your deductible and your copay. In-network is the list of service providers, including pharmacies, that agree to charge less for medical services. So a lot of health insurance plans, they want you to stay in-network. Basically, they give you a list of doctors that accept your insurance. Out-of-network, these are medical providers that are not within your circle of in-network doctors, which means your insurance may not cover out-of-network physicians. The Affordable Care Act is the law that requires all Americans to have health insurance or pay a penalty. And then finally, Medicare is that federal health insurance program for people who are 65 years or older, or for young people who have disabilities. So those are some of the medical insurance terms that we discussed in class. Finally, let's go through our automobile insurance definitions that we discussed. Bodily injury liability coverage, that pays for damages for bodily injury or death resulting in an accident for when you are at fault. Okay, so bodily injury liability covers for your injuries or death when you're at fault in a car accident. Comprehensive coverage, non-accident events such as hail or theft. So if you pay for comprehensive coverage, those are non-accident events. Collision coverage pays for damage to an insured vehicle when it gets hit or is hit by another object or car. So that's what they call collision coverage. When you need to have your insurance company intervene in a situation, that's called a claim. It's any request or demand for payment under the terms of the insurance policy. Similar to your medical insurance definition, your deductible is the portion of the claim that you pay out of pocket. And this is an important fact here that you want to be aware of. Basically, what happens is your deductible and your premium, they work in opposite directions. So if you have to pay a lot of money for your deductible, you might have to pay less per month. Maybe you pay $100 per month, but you have a $1,000 deductible. If you pay more per month, if your premium is high every month, then you're already paying the insurance company, which means you'll have a lower deductible. If you ever get to if you're ever involved in an accident, you're going to have to talk to the field adjuster. That's basically a person working for insurance who works outside of an office and meets personally with the public. And what they do is they negotiate claims, investigations, damage reports. So basically, the worker for the insurance company is known as the field adjuster. When you pay for car insurance, you are considered the insured, the person who purchases the insurance. The insurer is the company that provides your insurance for you. So you are the insured, and the insurance company is the insurer. Liability coverage is coverage when the accident is caused by you. Personal injury protection, or PIP, they pay for your medical treatments, lost wages, or other accident-related expenses, regardless who caused the accident. The coverage is subject to the terms, limits, and conditions of your policy, and is not always available in your state. So that's called personal injury protection. They may pay for your medical treatments, lost wages, and other accident-related expenses. The premium is the amount of money that you have to pay in order to have your insurance. Property liability coverage pays for damages to someone else's property if you are involved in an accident. So property liability pays for damages to someone else's property, someone else's car that you were involved in an accident with. And property liability coverage is when you are at fault in an accident, when the accident is caused by you. An umbrella policy is basically when you group a bunch of different types of insurance together. So like homeowners and your car insurance, maybe your life insurance. It's basically when you group together different types of insurance. Uninsured, a person who has no insurance, while the underinsured is a person that doesn't carry enough insurance to deal with a given situation. So uninsured, no insurance. Underinsured, don't have enough insurance for protection.